Hello and welcome to Chapter 21, International Lending and Financial Crises. So, international lending is really flows of financial claims, and that can be divided into different categories according to the type of lender or investor, and the usual categorization is private or official. Official meaning governmental. Maturity, whether it's short-term or long-term. Existence of management control, in other words, whether this is FDI, so there's a host country and a home country, so that the home country firm has control over that investment or not. And the type of borrower, whether it's private or whether it's government borrowing the money. So to elucidate on these things, private lending and investing, we've got both long-term and short-term. Long-term is definitely FDI. Why is FDI long-term? Because obviously it's to do with setting up a new commercial entity in another country, or investing in property. And most people don't, buy something one month and sell it the next month. You're usually buying it for a reason, because you want to retire to that country, or you want to have a holiday home in that country, or with companies, of course, you want to expand your market presence in that country. So you're in there for the long haul, in other words. Second is loans. Foreign borrowers not controlled by the lender, with maturity of more than 1 year, and this is mostly done by banks. Portfolio investment, part of this could be FDI as well, but that is purchasing stocks and bonds with maturity of more than 1 year, issued by a foreign government or a foreign enterprise not controlled by the investor. So if you have a holding of stocks, for instance, in a foreign country, that would be obviously long-term investing if you are holding it for a significant period of time. Short-term, anything that's not one of those things that we've covered, where you're basically in the country for a short time and you're likely to pull the money out very quickly. This can be purchasing stocks or bonds, and usually the maturity is less than a year. Usually a year is the kind of cut-off between short-term and long-term here. Official lending and investing, that's done by governments or multilateral institutions such as the IMF, International Monetary Fund, that is, or the World Bank, and that can be long-term or short-term. There's usually an emphasis on long-term, more than a year for most of the loans, though, to be honest, particularly in the developing country context, at any rate. So why does international lending occur? Well, why does lending occur? Is the question one might ask. Well, lending occurs because the lender obviously has decided not to spend that money, those resources, and has instead decided to forego the consumption that those resources could bring, and delay, I should say, not bring forward, delay the consumption to a future point in time. And this is the idea of intertemporal consumption, or intertemporal trade, if you like, as he's calling it there. But that's the first reason, obvious reason. From an international perspective, though, why do banks lend internationally? Well, they like to diversify their investments. And in fact, I've done a presentation just last year about the advantages of international portfolio diversification. If you hold stocks in different countries, you tend to protect yourself against an adverse event happening in one particular country. This is a really detailed analysis, which you should probably look at from the book, but I'll give you a rundown of how this works. First of all, those downward sloping curves there are the marginal products of capital. So that's the extra output from more unit of capital being deployed, and that experiences diminishing marginal returns. So it's downward sloping. So you can see on the left-hand axis, that's the percent per year in terms of rate of return of capital, but that's for Japan. The mirror image of that on the right-hand axis is, and you can see there's a curve there coming down from the right to the left, and it's labeled MPK America, marginal product of capital for America. That's also downward sloping, but it starts from the right-hand axis. So the assumption here is that there are two countries in the world, Japan and America. And first of all, there's no lending allowed. And if we look at all the wealth in the world, which is basically the ownership of capital, then Japan owns most of the wealth. So WJ there on the bottom axis is Japan's level of wealth. WA is America's level of wealth. This is just illustrative, by the way. It's not reality. It probably would be the other way around. But anyway, there's no lending allowed, and of course in reality there is lending allowed. So we end up at a point like point R. Now point R gives you that the return on capital in Japan is going to be 2%. Why? Because there's lots of capital employed in Japan, because the owners of capital from Japan cannot lend to the Americans in any case, so they're only deploying that capital within Japan. So that's why we're down at that point R. Now, the world has 10,000 units of capital, so the remaining 4,000 units are in the US. So we have to go up to point S on the marginal product of capital curve for the US to see what kind of interest rate that would require. And you can see in the case of the US, because the US doesn't have much capital in this example, capital is scarce, therefore the price of capital is scarce, therefore the interest rate to employ or deploy that capital is going to be higher. So here you can see in the US it's 8%. So one of the things about the marginal product to capital curves is the area underneath those curves, as they're marginal, the area underneath basically represents the total production, because it is the extra capital, the extra production, the extra output that results from another unit of the capital that's deployed. So that blue area in the entire diagram represents the total production that takes place in the world. Okay. Now we open up to lending, international lending. Now you can see that if we have international lending, then clearly America is a very attractive place, because the rate of return on any capital deployed in the US is 8%, whereas it's only 2% in Japan. So many of those Japanese owners of capital are going to say, oh, well, what's the point in investing in Japan? Might as well just invest in the US. So we'll lend to the US. So you can see what happens is lending will occur up to the point where we get to T. So in other words, the total amount of lending is going to be 6,000 minus 4,200. So that's the amount of capital that's going to end up being in the US. So essentially, Japan is going to end up lending just less than 2,000 units to the US, 1,800 to be exact. So now, what's happened to total production in the world? Well, we can, if we could measure the blue areas, but we've got to add in those labeled areas, B plus D plus F plus E plus C plus A, because that's where we end up. We're going to end up at both countries having a rate of return on their capital of 5%. So you can see we've expanded the amount of output in the world. We've maximized the amount of output in the world by doing that. So that's why international lending is good. You can see it deploys capital in the most productive of places, and the most productive of places means that you get the maximum return possible. Okay, so now if you want to look at the book, there's a bunch of calculations that they do figuring out the gains to the US, and the gains actually to the US end up being D plus E plus F. The gains to Japan are going to be that area there, B plus C plus A plus G plus H. Why? Because they've got the 5% and they've got that amount of capital deployed in the US. So the gains do go to both countries, and so everyone benefits basically. If you want to look at the logic of that, so then please refer to the book, because the logic is all in there, but hopefully I'm giving you the general logic of this diagram. So we compared free international lending with no international lending. We found the orthodox result: freedom of movement of capital, that is, raises world products, world output, and if we're raising world output, presumably someone's getting paid for that output, so it raises national incomes to their maximum level. Another standard result also carries over from trade analysis, that is the nationally optimal tax. If a country looms large enough to have power over the world market rate of return, it can exploit this market power to its own advantage at the expense of other countries and the world as a whole. So in other words, it can levy the appropriate tax, and that will benefit it over other countries. So what about actual international lending? Well, most international lending is well behaved. We're going to talk later on in the chapter about lending that's not well behaved, but most international borrowing and lending is well behaved. Usually both the lender and borrower do benefit from the lending that occurs, and countries with the net savings get higher returns, and countries that are net borrowers pay lower costs by being able to access international capital markets. So international financial investments are also are used to lower risk through portfolio diversification as well. So the country that lends tends to have more diversified portfolios, and you do get conflicts sometimes over tax policies. Every country has jurisdiction over its own tax policies, and there's very little international coordination of those tax policies, by the way. There are only international tax treaties that occur between individual countries, and those are complex to say the least. That's why multinationals, by the way, end up hiring whole armies of lawyers and accountants to figure it all out. It really is, when you think of it, it's a waste of resources, but unfortunately that's the way the world is. Sometimes we get non-well-behaved international lending, and that often occurs in the most obvious way in a developing country financial crisis, where the country experiences difficulties in making interest payments on loans it's got or servicing its debts, and that's called defaulting, by the way, and that occurs quite frequently, in fact, more frequently than you might guess. So lenders cut back or stop new lending, and the borrower is viewed then as too risky. What's interesting about some recent studies that I've looked at is that even though countries default, oftentimes lenders after a year or two go back and lend them more, even though they default. So there's some countries that have defaulted many times. Actually, the US did default many years ago. It hasn't defaulted recently, but there was the threat of default actually a few summers ago. It was about 5 summers ago, I think. The US threatened to default because it refused to raise its debt limits on its debt, and that would have meant interest rates on its bonds would have been withheld. That then would be, by definition, a default. So when we look at international lending to developing countries, there's a whole story here really, and it's, you know, most of his chapters are really short in this book, Pujoul's chapters, but this one is a long one, I have to say. If you have the time, sit down and read the chapter. It's a good read, well written, but I'm just going to skim through most of the history here. Really these are the episodes in recent history anyway. So from 74 to 82 we had a surge in international lending. Then in 82 we had a big debt crisis, and that led to a rethink and the so-called Brady Plan. We had then a resurgence of capital flows in the 1990s, and then we had a series of financial crises from the mid-1990s through to the Argentinian crisis, detailed here, 2002. So the Mexican crisis, or what's often known as the tequila crisis, Asian crisis, which really was limited to Asian countries, but there were quite a few Asian countries involved, as we'll see. The Russian crisis of 1998, that was just limited to Russia. And Argentina's crisis, which was a deep crisis, in fact, for Argentina, and also affected countries around Argentina during that time, between 2001 and 2002. So here he talks about these different episodes. So surge in international lending from 74 to 82. Those are all shocks in the 70s. The OPEC oil shocks led to a surge in private international lending to developing countries, and four forces combined to create the surge. So there's firstly, rich oil exporting countries had high short-run propensity to save out of their extra income, and they tended to invest those savings in liquid form, especially in bonds and bank deposits. There was widespread pessimism about the profitability of capital formation in industrialized countries, so many of those oil revenue countries decided to put their money into developing countries instead. The 70s was also an era of peak resistance to foreign direct investment, in which the foreign investor, usually a multinational firm based in an industrialized country, keeps controlling ownership of foreign affiliated enterprises. And we also had herding behavior, meant that the lending to developing countries acquired a momentum all of its own once it began to increase. Yes, investors and governments, for that matter, started throwing money at developing countries. I remember the thinking at that time was that these developing countries were the future. They had faster growth rates, and this is where you should put your money if you wanted to gain the maximum return. So the debt crisis of 1982 came about. What caused that crisis? Well, interest rates increased in the US rapidly as the US tightened monetary policy. Then the US and several other industrialized countries went into recession. Those developing countries' exports were no longer in as much demand. That meant that commodity prices internationally fell while interest rates remained high. This really hurt developing countries because suddenly what they had as their exports weren't in demand, so they weren't earning those export dollars to repay on their debts. And so several countries had huge debt problems. There was then a resurgence of the capital flows in the 1990s. The size and scope of this Brady Plan led investors to believe that the previous crisis was being resolved. But low US interest rates led lenders to seek out higher returns through foreign investments. Developing countries were becoming more attractive places to lend as governments reformed their policies, and individual investors as well as mutual funds and pension funds were looking for new forms of portfolio investments that could raise returns and add diversification to portfolios. Then we had the so-called Mexican crisis, 1994-95. The government replaced these peso-denominated government debt with short-term dollar-index government debt called peso bonos, treasury bonds, basically. And they tried to fix the Mexican peso, and it's kind of guaranteed a good return on those peso bonos, hoping that US investors would put their money into Mexico. They did, But the trouble is, then the Mexican government started to get into trouble, and it looked as though they were going to change the exchange rate. Well, that caused a large flight of capital out of Mexico, mostly by Mexican residents, who feared a currency devaluation and therefore shifted out of pesos into dollars. Investors refused to purchase those new tesobonos to pay off those coming due because it appeared that the government did not have the ability to cover its dollar obligations. As investors reassessed their investments in emerging markets, they pulled back, not only in Mexico but in other countries. This was the tequila effect. And the US government permitted Mexico to borrow money to pay off the tesobonos as they matured, to replenish its reserve holdings. So in fact the US government came to the rescue of the Mexican government during that crisis. Okay, I'm going to make that part 1. I'll come back and do part 2 from this point onwards.